In a recent event, Charlie Munger predicts that an upcoming economic crisis is bound to happen, but this one is more dangerous than any other. This is Investing Path, and for today's video, we'll be talking about Charlie Munger's thoughts about this inflationary bubble that we're about to experience soon. But before we move along, please make sure to give this video a thumbs up, and if you'd like to see more of our future content about financing and personal investment, then don't forget to click the subscribe and bell button to stay updated. Now, we won't make you wait for too long, so let's get into it. At first, Charlie Munger mentioned that we're in quite a bubble. He elaborated it by saying that when modern governments manufacture money on a vast scale, we enter unknown territory. We've never done anything like what we're doing today, and we know from other nations that printing too much money eventually causes terrible trouble. We're closer to a terrible trouble than ever before, but it may still be far off. Charlie Munger hopes it does. He mentioned that after the 1970s, Volcker hiked the primary to 20%, and the government was paying 15% on government bonds, causing a prolonged, painful recession. Volcker's ability to act without political interference was remarkable, but we think it was for the best in 2020. We don't think today's politicians would be as sympathetic to a new Volcker bringing on a recession. Thus, Charlie Munger anticipates that the new obstacles will be distinct from the old ones. A Volcker-style recession would have been ideal. Our problems may be harder to solve than Volcker's. According to Plato, this is how Greek city-state democracy worked. Demagogues and their followers can easily destabilize a democracy founded on universal suffrage and complex laws. Plato's idea wasn't crazy, as Charlie Munger thought so. It's unclear if our problems will be like Japan's or much worse. The fact that we have no idea how things will end out adds an exciting element to our existence. We are probably aware we are courting calamity. Our initial worries were unfounded. Japan has remained a civilized nation despite unfathomable money printing. Consider how alluring that might be. You've paid off interest-bearing bills with interest-free accounts. Imagine how appealing that would be to lawmakers. The removal of interest payments and a growth in the money supply may sound like a dream come true. But when something is so enticing, its use is likely to increase beyond its intended purpose. Charlie Munger's way of life didn't anticipate minor short-term disparities between the Russell and Standard Poor's indices. Now, we should only worry if it's a wise investment and if we prefer to swim against the current. Investing in equities or real estate over long term will always involve pain and gain in the long run. Treat those two imposters the same. As Kipling put it, you are going to have to adjust to both day and night. How much does that annoy you? No, it can be daytime or nighttime or any one time. The results can vary widely, from booming success to catastrophic failure. And Charlie Munger thinks you should give it your all and keep going as long as you can get away with it. Now, the question lies on what impact does passive investing had on stock valuations? Charlie Munger says that it's definitely going to be huge. This is another impending event. Shareholders and index fund investors have emerged as new emperors. Perhaps we can convert BlackRock CEO Larry Fink and the Vanguard Group. This rapid, massive shift in voting power to passive index funds will have far-reaching effects. And while Charlie Munger says that he can say for sure what those effects will be, he has quite of a bad feeling about them. You wouldn't believe what a modern factory looks like when it's packed for the gills with robots. And it's coming more and more and more. And it's coming to China, for that matter, and so, we think it does create adjustment problems. You are in a bind if you get unionized job and then a robot takes your position. If your company is anything like Kodak and a new invention comes along, that makes your product irrelevant. You have a problem, and the only way to fix it is to go out of business. Some people aren't fond of that answer. Simply giving a guy a non-interest-bearing checking account in place of the one you used to have to pay interest to each month would solve all your problems and be very tempting. We have a serious problem, and the Federal Reserve and politicians' go-to remedy for it is to print more money to alleviate the short-term pain without considering the long-term consequences. It is well known that the emergence of Hitler was aided by the Weimar Republic's reckless money production, which led to the country's economic collapse. We don't want our legislators to take the path of at least resistance, since, after all, it didn't damage us before. Now that we know that we can double it, and then double it again, and so on forever, we're all aware of what occurs on that endless cycle of multiplication. If enough people act in this way, the government will change dramatically. Unless there's discipline in the process, you're playing with fire someplace. But Charlie Munger says that doesn't see Japan as being in any great peril, having given the only huge quantity of this and gotten away with it. To be honest, he doesn't think we'll be able to solve our problems as well as Japan has. Meanwhile, as for Charlie Munger was questioned about the situation of moving into cash now and waiting for greater opportunities to deploy the capital over the following 12 months if taxes were not an issue, and if he thinks it's a good plan. He answered it by saying that he never saved money in anticipation of favorable prospects. For the time being, I don't plan on changing his mind on the greatest option he found. Furthermore, the Daily Journal depleted its financial resources. Now, Berkshire has a lot of cash on hand, but it isn't sitting on it since Buffett believes that company can time the market well. Nothing appeals to Buffett enough for him to make a purchase. As you can see, Charlie Munger cannot offer a solution to your problem, and instead, he suggests that we must cope with the methods he has given. Now, another question arises on why isn't Berkshire acquiring any new companies, given the valuation and market drop expected to begin in early 2020. Well, the team deserves credit for investing in Apple shares a few years ago. They've clearly paid off. To put it simply, Charlie Munger answers this by saying that they can't find anything else to buy at a price they're ready to pay, which is why they're making this purchase. Some people are driving up the price by bidding, and many of the buyers don't intend to keep them. A large portion of private equity acquisitions are motivated by the hope of generating further management fees. Even though it's much simpler to make a purchase when you have access to someone else's cash, they're not really borrowing anyone's money. Rather, they're just spending what they consider to be their own. He's always held the view that no amount of money can buy happiness, and that even a great store like Costco would eventually reach a price at which he'd say, "That's too high." However, he would argue that he would purchase Costco at the current price if he were investing money for a sovereign wealth fund or a pension fund with a 30, 40, or a 50-year time horizon. As an afterthought, the fact that Berkshire has surplus funds that they are not now investing in is not tragic. As Charlie Munger describes it, when we have more money, we appear more responsible, and we actually are more responsible. Investors who are concerned about the company's future because it appears complex and challenging pose a threat. To everyone fretting over the economy, the republic's future, and similar issues, relax. We must take inflation extremely seriously. One may make the case that this is the end of a democracy. A major cause of democracy's demise in Latin America is rampant inflation. It's a major risk once the people figure out they can vote themselves paychecks. There is a significant risk of long-term destruction to your society if you push things too far. Consider the Roman Republic, which persisted long after the transition to an absolute monarchy in the form of the Roman Empire. They kept the money in constant inflation for hundreds of years, which led to the fall of the entire Roman Empire. Therefore, it poses the greatest potential threat to humanity in the long run, perhaps even more so than the nuclear war. As a result of the high risk of loss, Charlie Munger believes that the only appropriate course of action for an investor over the next century is to consume as little of it as possible, since we expect the value of the currency to drop to zero. Weimar inflation, which wiped out the savings of the middle class in Germany, was followed by the Great Depression, like a knockout blow. Enter Hitler, a crazy demagogue who received 40% of the vote, and pretty soon we had a dictator who was determined to start World War I. So, the past is unpleasant, and the Germany that Hitler conquered was a highly developed and civilized country. In other words, we've proven that in a contemporary democracy in the age of Keynes. You're going to have a huge government reaction if you allow your nation to decline to the point where you get a Hitler. This outpouring of support beyond anything the United States had seen before. They just poured money at the problem. They had a good reason to worry about the outcome and be generous with their spending, but they may have gone a bit too far. It's hard for the restaurants to find workers because they got so much money so rapidly. But he also added that he can't blame them. When time is of the essence, it's challenging to make sound judgments. You can only have faith in the technical prowess of our culture if you look back 100 years to the year 2022. The previous century also saw a significant increase in the rate of modernization. while the preceding thousands of years were largely unremarkable. No printing press, no air conditioning, no modern medical, and other similar things meant that life was rough and short and limited. Things from my list of the genuine human needs don't seem likely to materialize. Think about the significance of obtaining. Let's pretend that first you acquired the steam engine, the steamship, the railroad, some agrarian and plumbing advancements. That's what the century that ended in 1922 brought you. The United States is a vastly different environment from what happened there, where obesity is the primary issue facing the poor. They were on the verge of starvation in the past, but now, with rising prosperity, greater personal autonomy, diminishing racial disparities, and other signs of modern progress, they are thriving. People are less content with the current state of affairs than they were when times were much tougher. The world is not driven by greed, it's driven by envy, and the reality that everybody's 5 times better off than they used to be. They don't appreciate it, and all they can think about is how unfair it is that someone else has more than they do. For this reason, God appeared to Moses and commanded him not to covet his neighbor's wife, or even his donkey. Even ancient Jews struggled with feelings of envy. It's just in our DNA. Charlie Munger finds it strange for someone his age, because he lived through the Great Depression's unimaginable poverty. After all his wealth, he felt safer strolling the streets of Omaha at night than he does in his own neighborhood in Los Angeles. And there's nothing he can do about it. Even though his life improved by roughly 600%, many people are still quite unhappy and feel highly exploited. This is because there will always be someone else who has more. Think of the pretentious expenditures of the rich. Who in the hell needs a Rolex watch so you can get mugged for it? Yet everybody wants to have a pretentious expenditure, and that helps drive demand in our modern capitalist society. My advice to young people is, don't go there. The hell with a pretentious expenditure. I don't think there's much happiness in it, but it does drive the civilization we actually have. It drives dissatisfaction. And finally, what will happen next? And in addition to investing in quality stocks, what other suggestions does Charlie Munger has for us, private investors looking to protect themselves from the potentially disastrous effects of inflation? Charlie Munger says that you are unlucky if you've got 4 solid assets. Perfect diversification is portrayed as professional investing by finance instructors and the media. Very few people have enough wits to get 20 decent investments, and if you are attempting to do better than average, you are lucky if you have 4 things to buy. It will be a lot more challenging for the group than it was to finish college at the time. That they may become wealthy, maintain their wealth, and amass even more wealth. They'll have it much tougher than my generation had. Consider how much it would cost you to buy a property in a good Los Angeles neighborhood. Income taxes will likely go hiked as a result, and so on. We all find the investment world challenging enough as it is. Owning a diversified portfolio of common stocks that was slightly updated by adding the new ones that came in, like the Apples and the Alphabets and so on, was ideal at that time. And we'd say the people got maybe 10 or 11% if you did that very intelligently, before inflation, and maybe 9% after inflation, which was a marvelous return. We don't think the future will give the person graduating from college this year nearly that easy in an investing opportunity. We think it's going to be a lot harder. No other generation in the history of the planet ever earned returns like that. Some people have the skills to put money into things that are difficult to evaluate, while others would be wise to set more reasonable goals for the types of issues they take on. So somewhat perplexing, we would say welcome to adult life. But we think you need to figure out your degree of skill or the level of skill your advisor has, and that should enter the equation. And that concludes our video for today. We thank you so much for watching, and we hope you learned a thing or two. If you have any thoughts or questions in mind, then feel free to share them in the comment section below, and let's have a discussion about it. We are glad that you took the time to watch this video, so please make sure to give this one a thumbs up and click the subscribe and bell button as well to stay updated for more of our future uploads. Once again, this is Investing Path. Thanks again for watching, and we'll see you on our next video.